you know, it comes down, and again, long comes down, long comes down, long comes down, long, and you just want to get in there, and then it liquidates you. Quick disclaimer, these videos are meant for educational purposes only. Anything said or shown in any of these videos are personal opinion and my perspective. Trading carries a high level of risk, so anything done is your responsibility. Hey, how's it going, guys? Welcome back to mentfx, and in this video we are going to do an overall breakdown of taking the last few videos I showed you guys with the idea of, you know, having a structural impulse act as a further continuation rather than looking for the pullbacks into a zone, and instead looking forward to continue delivering to the top side, right? As well as that, we're going to see how that combination of Dow Theory, of Elliot wave theory, right, and of overall Wyckoff theory creates for us an actual setup that we're willing to take and actually get involved on. And I'm going to show you guys that from a lens of a setup I actually took. It didn't end up running a very far way. I only secured about 10 RR on the actual position. I'm going to break that down for you specifically from the day that I started with it, with my bias that I sent out to the group, right? So we're going to play this forward to when I sent this out to the group, and the bias was basically sent to the group at around, we had that down move right there, and then that up move right there. So the bias I sent out to my group was around this time right here, and I sent out that it would continue long. I actually sent out something right before that as well, so you can see I sent it out right here, looking forward to either retrace and keep going or already just take off due to the nature of the pullback. And today we're going to talk about this trade, break it down, and show you exactly how we use those Dow Theory, Elliot wave theory, Wyckoff theory, and elements of smart money to create an overall trade plan and actually execute trades. Now, if you haven't seen my most recent video before this one, I do suggest you watch it. It's really important. Otherwise, let's get right into it, right? So one thing that I spoke about that's important and very vital in your understanding of Elliot wave theory is, you know, is the context of the fact that, you know, we have normal Dow theory right here, which is the higher highs and higher lows, right? We have normal Elliot wave theory, which is the idea that even when we have higher highs and higher lows, there can be liquidations because those liquidations are part of a higher degrees structural impulse. So we're okay with expecting potential breaks in structure to continue focusing on a given bias, right? Which means, as you guys remember, and I showed you countless examples now, in this overall move here, right? We had a weekly zone from here to here. We had a zone marked out as a result of that move somewhere within these areas. Price came into that area, accumulated, began to go long. And as it began to go long on this daily, we followed the bullish impulses and bullish 3-box setups, such as impulse, S&D, confirmation. Impulse, S&D, no confirm. Impulse, S&D, no confirm, right? Impulse, S&D, no confirm, but it breaks down, right? Then becomes bearish. So this becomes a bearish 3-box, but we don't follow it because we are aware of the fact that we are in an overall bullish market. AKA, we're aware that we are undergoing one of those times where we have a bullish market that's doing this, right? But at the same time, we're aware that that bullish market is part of a larger time frame structure, right? As I teach you guys to think on this channel. So we're aware of that Elliot wave theory partnered with normal Dow theory, showing us that we should expect price to potentially make liquidations, right? And that's where that Wyckoff and SMC element comes in, because as we have those zones, those are those SMC or those Wyckoff places where we can expect to see those transfers of weak to strong hands. So simply, let's do a top down and break down exactly what I was looking for this week. So in the mentorship, as we broke it down, we actually said, you know, the daily's been bullish. It's been very bullish. We were going to expect that price is going to continue running new highs. So when we did the analysis on this candle here did not exist, right? However, now it does exist, and that's the beautiful run. So at this time, we understand that a lot of retail's already short on this. A lot of retail's looking at this as a break of structure here without recognizing where we are in an overall push, right? That we're still looking to go bullish. And as a result, you know, a lot of them are still short on a market that is extremely, extremely bullish, right? About 76% still. This was like 80% like last week or something, right? It's absolutely insane. However, a bullish market, so the analysis was to be bullish, right? On the 1 hour, when we were making this analysis, so again, that's what you saw me send out. So I'm going to go ahead and show you where that was, right? So when I sent this out in the Discord, And again, to join this, it's just the link in the description and the link on the bottom of my screen. So very simple to join if you want to be a part of it. I will never message you first. Please don't get scammed. You know, it's just dumb if you get scammed by someone that's messaging you with investment advice. I don't invest for you. I don't do signals for you. I don't do any of that. I'm here to educate you and to make you actually, and to give you the things you need, the tools you need to actually excel in this industry. If you're looking for signals, this is not the place for you. Go somewhere else. This is probably not the industry for you too. The only way to make money in this industry is to do it yourself, to take responsibility for your own learning, and to basically learn to earn. There's no such thing as earn and learn at the same time. It's the dumbest thing ever, so don't play into that, right? So this is the bias I sent out right here. You can see that was sent out just about right here is when I sent the bias out on this point right here. And basically the reason we did that is because, again, for the week, we're aware that what we're looking for is the continuation of that daily structure because it is bullish, therefore it should remain bullish. Remember how we act in this market. We don't look for major pullbacks, we look to play with the trend. And if we know that under Dow Theory or structural theory or the composite man moving and marking up theory, price is already bullish, the idea is that price should remain continuing to deliver bullishly, which means, you know, it can stop somewhere and continue bullish. And even though the start of the week showed us some very nice, you know, 3-box setups on the downside, so we had a break of structure here, you know, a beautiful setup right here, another break of structure right here, you know, so another beautiful setup in right here, right? Even though these 3-box setups are delivering very well, and there actually might be very good RR plays within here and here and here for Wyckoff setups, we do not trade these because we're aware of the fact that we are in an overall long market, and we're aware that these breakdowns and pullbacks are going to be most likely part of a higher degree structural pullback that's then going to continue long. And lo and behold, as we waited for that week to play out, we had this break of structure right here to the top side, and upon getting that break of structure to the top side, I like this S&D right here for a potential long, but the overall bias is still holding long. So now we have a bullish bias with a bullish delivery we want to see on the top side, as well as a now bearish to bullish shift in market structure, right? Showing us that we now want to move to the bullish side, and that now the composite man or smart money is on the bullish side looking to accumulate. So whether that be price coming back in here and accumulating to go long, or price just continuing to accumulate onwards and onwards and onwards, we're aware that the bullish bias is now back in order, back in motion, and that's what we want to follow. So I don't get in, even though there are valid trades here, there's no reason for me to take them. Even though they're valid, they're not valid under the composite story. They're not valid under the smart money story that's delivering. And even though, you know, they worked out here, most of the time, the probabilities are going to be against you if you're trying to force sells into a market that is already bullish. Right now, again, I actually took a sell in here that actually ended up break even, I believe. Let me go find that very quickly. Right, so you'll see that, yeah, I actually did take a sell in there. I'm not going to break down the exact reasoning for that sell because, like I said, these are private mentorship concepts, because I do have a tiny bit of differences between the public YouTube and the private concepts, and there's entry confirmations in the private that are different from the public. So I did take a sell here, and then that ran, and then, you know, I had a first partial set right here, but that instantly came back to break even. And once again, I was continuing to look for that continuation bullish, right? Now, that runs to the bullish side, and let's talk about my actual trade that occurred, right? So on the 1 minute, so let's actually mark this out, right? We're aware that the 1 hour had this high to clear now as part of the structure, but we're also, in this case, aware of something else. And that is, as you remember in the last video, near the end when I dropped this psychological gem, so I'm not going to go in depth on it here, but it's very good, so make sure you've seen the previous video. In Dow Theory, something you spoke about that's really important, something that I utilize myself, and something that actually works even with the Wyckoffian concept put together, is the idea that when you have a trend in order, so let's draw a real trend, right? A real uptrend. So something like this, right? There's the Elliot wave inside there where it breaks down, right? Keeps going long, you know, maybe breaks down again, gives you an entry here, whatever, and it's long, right? This is still a very long market, despite looking like it maybe went bearish sometimes. And the reason for that is because, you know, one, we have Elliot wave theory, which is playing out, which is the higher degree is making the bullish plays, but also something that Dow introduced is the idea that a trend can be considered potentially changed when you have a break and then a continuation break. So you need a double break to actually signify that there is a reason for some kind of smart money or some kind of big players to actually go short and to actually protect certain highs. Otherwise, most of the time, what you're going to see is price is going to make a break below a low like this, and a lot of you are already, once again, set on potentially going short here and anywhere else, head and shoulders, wherever you're trying to go short. And what's happening is, as you're trying to get short here, it's going long. And it's going long. Whereas what I'm doing in moments like this is looking to continue getting position long. Kind of what's happening in here currently, right? And the reasoning for that is because, once again, you have Elliot wave theory coming in motion where all these moves are just larger degrees, right? And the Dow theory hasn't now backed up the fact that we are in a bearish market. However, if price makes a pullback and then breaks again, now we have officially created a idea, right? A philosophy where smart money is potentially getting now positioned short for real. And there's a good chance that we can expect this to either, come and test and continue drizzling down, or continue drizzling down, right? Maybe making some move down here and then hitting and then going short, right? And again, the reason we use this double break is because it makes us aware that a break like this could be a liquidity grab rather than a continuation. And you can also use the video that's called displacement on my channel to also ascertain certain impulses as to whether or not they're going to actually hold through or fail. So make sure you check that video out if you have not seen it. Now, that said, this is what makes us aware of that. So we know that now we have, we had a bearish market, a breakup. This could have been a liquidity grab that could have then just continued the segue back down and break back down, because then that would make it part of this larger degree bearish structure. However, because we're in a bullish nature, that's why we are already able to consider going long even off of the first break from the most intermediary, or not the intermediary, from the most recent unmitigated zone, which is this wick in this case. Well, actually, the zone was this one, which is what actually got hit. You can see from wick to wick. However, this is what I highlighted for myself because for me, the story made sense there, even though it didn't get there, right? But now what we also have is this break one to the top side and this second break to the top side, which means what we've put in motion is Dow's theory of continuation, right? So when we have that double break, smart money is now officially in on some kind of large move, and the composite man, if we are to continue going long, is going to look for a way to set up a certain 3-box setup, right? Where we can then confirm it with Wyckoff to continue going long and then sustain that move forward. We had a lot of traders in our mentorship get involved in here, and in here, and then held this all the way up to new highs somewhere like all the way up here, like insane trades. I think I spoke about that in my last few videos, right? Where they hit over like 1 to 180 RR, absolutely insane. And again, remember, that is not 180%. If you're new, don't go into the comments and start saying, oh my God, 180 RR, impossible. It's very much possible. A lot of our traders do it. Not the entire position is still running by the time it's at 1 to 180, but also this is how we look to get involved. As we get positioned, we're aware of the fact that money can break out. And if you're positioned in a way that is like that, as price breaks forward, this is all profit that you are potentially running forward on, right? So at this point, we have the double break, which means we've signified a very bullish market, right? Now, my entry itself, let me double check exactly where my entry is. So my entry was as we broke up here. So I'm going to break this back just right here and show you exactly where my entry was. So go to the hourly. You can see at that point, the hourly was already reaching above that area. So we've had an intermediary double break. So we have a good, we have a very good story to tell about this market continuing bullish, right? We have an overall bullish market that has been going extremely bullish for a long time. We've had a weekly that's been in a very big bullish range for a very long time. We've had a daily that has continued to undergo markups after markup after markup of 3-box setups and continuations over and over and over again. And this week, we expect it to continue doing so without any hesitation. And we've just switched from a bearish market into a bullish market. And not only have we impulsed to the bullish side, we've also created the double break, right? Thereby signifying the Dow theory of continuation, which now is basically showing us that smart money is positioned in some way on the long side, is ready to take it to the long side, which means across time frames, we are likely to expect potential buys. Now, this is where my last few videos come in very big handy, right? Because already, even though this is breaking, a lot of dumber smart money or dumber, YouTube channels teaching smart money or even mentorships are already looking here and basically looking to force the market short before going long, or even looking down here still and waiting to short the market before getting long, without once again recognizing in the case that you have a bullish market, the likelihood of that market is actually to continue to the bullish side rather than make a pullback. If it makes the pullback, great, you can look for a confirm. Otherwise, it's actually more likely to continue breaking to the top side. So at that point, I actually jumped down to the 1 minute, to be honest with you guys. And as I followed this 1 minute, what did I see? So once again, I want to follow structure of the 1 minute to find out where I am in that story. And, let's mark it up. Let's make it simple. Right? What we always do is we want to start a little bit from the left and find out where we were structurally, because again, this might not be a break. I mean, in this case, it's going to be, but it might not be in a different case, because we need to be aware of where we are in an overall market. So we'll start somewhere on the left because we need to follow the structural narrative on a given time frame. So we have a high made, price breaks down, makes a low, then breaks the high right here, right? So we become bullish, then it re-breaks down, becomes bearish, and then breaks to the top side and breaks to the top side again, right? So what are you seeing here? You're seeing a market that was playing around, was bearish, that has now become double bullish again, right? Which means, once again, you have that Dow theory of continuation of a higher high and a higher low and another higher high and higher low being put in, which means now across timeframes, you have that occurring, right? So at that point, what I did is I said, okay, what we have is some kind of break here, and we have this SND that caused it, because once again, we have box number 1, box number 2, and now we need price to get there to be box number 3, because now we have a valid 3-box setup within of an overall story that is showing us that it wants to be bullish, right? I also, at this point, step down between timeframes, because as we work between timeframes, we can see the volume in the actual candles. We can see how the composite man or the algorithmic, computers, financial institutions, whatever you want to call them, but how the composite man at this given point actually manipulated that price and where that mitigation is most likely to take place if it does. So again, same thing goes. This is a bullish break. The odds of continuing are higher than price going down. However, if it comes down and hits our zone, then we can confirm. Remember, and again, if you don't know what the fuck I'm talking about, make sure you go back through my last few videos, or even start from number 1 and work your way up. And this will all become very understandable, because the thing is, I cannot make every video very beginner based at all. It's impossible to do that. So every video is a buildup of the prior video, which is why it's really important that you see them. Now, again, some of you are in this space or might be in this space, and you might have gotten some bad education, but you might still understand what I'm talking about. However, I do suggest you make sure that you are basically learning the mentfx way and then following the mentfx way going forward as you see my videos, right? So all we're doing is we're marking up our areas and expecting price to potentially come back, but we're not forcing anything. So at this point, I went to a 30-second and looked at it and said, okay, on the 30-second, do we see anything different? Nope, there's still that break. It's still coming from either here or here, right? You can see both of these candles work. However, the black candle makes more sense. Why? Because we can basically tell from looking at this that as price was being played around in this area, major sells came in right here at this open, pushed, waited around, and then blew up through the tops. So we know that the major volume that came into this market on behalf of the composite man, or on behalf of smart retail, or on behalf of smart money, or on behalf of large hedge funds or institutions or whatever it might be, it doesn't matter who it is. There's minor participants constantly that are on the smart side and understand what they're looking for in this market and where that smart money entry can be had. That is why this applies fractally across all time frames, whether it be a 30-second, 15-second, 5-second, 1 second, 1 hour, weekly, 3-day, daily, 2-day, blah, 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 right? Any of them. It does not matter. So I actually went to the 15-second just to double check, right, and continued following this. And what I noticed here is a new refinement that I didn't notice on the others. This is the importance of multiple time frame analysis, or top down. Again, you don't need the seconds, but this is why even when you do high time frame analysis, you need to use a few of them to really tell where you are in the market. And the reasoning for that is, again, this zone now, this volume candle that had those major sells into it and then it played around here, took off, but then actually had price come back down. So there was another impulsive sell back into it on behalf of, once again, the institutions or the composite man to mitigate those prior sells before the buys, creating that SND 2.0. So if you don't know what I'm talking about now, it might remind you, or you could just go like this and you could type in, what is it, SND 2.0 mentfx. So when you hear me say things, right, so I called it OB 2.0. Again, it's an SND 2.0, but you can use whatever terminology you want. Check out this video right here. So when you hear me say certain things and you don't know what they are, there is almost 100% guaranteed chance that I've shown it on my channel somewhere. So make sure you pause the video, type it in, and then look it up. But let's follow this movement. Think about what's occurring here. price, so we're going to start by this candle, right? So let's start right here. Imagine we're on this black candle. Institutions come in heavily and sell into it to that low, come up, and price closes right there, right? That's the close right there. You can see that. Then price gaps and opens right here, comes up to make this high, and closes right there, right? So that's this candle right here, this second candle. Now let's look at the next one. It opens and closes right there. Then the next one, it looks like it opens right here, makes a low right there. So that's this low right there on that wick candle, comes up impulsively to that high, and then it closes right there, back again at this level. And then opens again, takes off impulsively to that high, comes down and closes right there at that high, right? So again, I'm just drawing out that price so you can visualize it, because again, what we're doing is fractal. We need to understand this across time frames, right? Next candle opens a little bit higher right there, comes down impulsively, wicks that low, comes up and closes right there, and then just takes off, right? Here we go. There we go. Now, again, what do you see as you follow this? Well, what you see is the down moves are being mitigated. The down moves are being mitigated, and then the impulsive move really comes from some kind of down move inside of right here. You see that? So you can tell that the last down move in this market here came from right here, which is equivalent to this candle right here. And now we can delete this one. So at this point, what I did is I refined my own candle using the understanding of volume between time frames, right? So you can see the volume within the candles by following each time frame and viewing what occurred on that time frame. And in this case, what we see is a manipulation down, a validation of that manipulation, right? Because we trade above it. So the structure was traded above there, right here. The structure broke out. Then price returned to retest that structure, or as we can call it, to retest the sells before the buys, thereby mitigating those positions, but leaving behind the new sell before the buy. So you could also refine it to this candle, really. This is like the valid one, but this one makes the most sense because of this fractal here. Okay. Came down to mitigate it and then took off impulsively. So the candle that was left unmitigated as part of this 3-box, right, from that low to that high, notated by these purple little dots, was this candle here. And that's the candle that I went ahead at that point and set an alert at, just like this. Boom. Set an alert and walked away to go make some coffee really quick, because I'm always on coffee. You guys know it. So again, right, notice how just by going between the time frames, we were able to refine to an area, and notice that it takes into account potential imbalances on other time frames, but we don't need to know about imbalances to be able to refine zones the way we do. All we need to know is what point was left unmitigated and what makes the most sense. And as we play between time frames and view that from a volumist standpoint, we're seeing exactly how volume played out and where those moves came from. Now, you could keep going lower. I didn't. I stayed on the 15-second, and that was it for me. But that's what I decided on, was this candle here. So you could use the entire one like that, but I used it to the wick. Either way, there's multiple valid ways to do this, but this is the candle that made sense, because the last candle here that was a down move was this one. And you can see it was mitigated by this move and then continued going long. So that mitigation, this down move, came from this wick's high. So that's where we find that out, right? And again, on the order flow booklets and on people that are viewing, you know, the little DOM or the order flow, whatever they view, or even prop firms that are utilizing those liquidity points to trade, because not everyone uses candlesticks, they're seeing this price action in a different way. Their data is just presented differently. Even if you're using volume at the bottom of your chart and you're looking for that divergence between volume, you're going to be able to see that volume divergence or where that volume came from within the candles by looking at the actual movement. And that's more clear and precise than any other tool you're ever going to use, because it's the actual price of buying and selling, whereas volume doesn't always present every single data point correctly. Okay, so that's a lot of data to take in there. You guys don't have to believe me on this. I've been doing this forever. I've been teaching it a lot, and people have been able to basically take their own understanding to levels that are incomprehensible even to them, you know, over the last year and a half. So if you want to do that, you know, keep watching my videos or join up with the mentorship. One of the best places to be, and I have a community that is absolutely stunning. We have, you know, webinars every single Sunday where we mark up, break down over and over and over again, and we have some of the highest end quality content that takes you from step 1 until the very end of this entire understanding for you to actually have. But it does take time, so if you don't have time to dedicate, do not join. Okay. Now, that is the zone I chose. Okay. So that's the zone I set my alert at, and it made the most sense from a volume standpoint. Now, this is part of that 1 minute range. So at this point, what my basis is that if we make a pullback and break structure, this is no longer valid for me. There's nothing to follow there anymore. It's done. The point is spent. It's useless. Smart money is not going to make the move it needs to make there, and there are new ranges to now follow. On the other hand, if price continues to just mark up, then it is what it is. You miss moves. That's part of the game. Remember, on a higher time frame right now, it's actually within that state. It's just marking up. But instead of forcing, the dumb retail or other dumb smart money, forcing the sells back down to an area that you want to see buys at, we're looking for ways to get positioned with the trend, because this is what real trend following looks like. We are following the trend of, basic Dow structure, Elliot wave understanding structure, Wyckoff accumulations, reaccumulations, and with the knowledge that we're in an overall markup. So even when I'm here, right here on my 15-second, there is still a cohesive story that is being told from the highest time frame. What does that mean? That means right now, the reason I'm able to take this trade right here, right, and then confirm it, as I'm going to show you guys in a second, and I have the confidence to actually do it, isn't because, it's just my 3-box setup, which, by the way, is one of the best setups you'll ever learn in your life. Yes, it is a 3-box setup. And if you don't know what I'm talking about, same thing goes. 3-box, mentfx. Beautiful. Watch it. You guys will love it, right? You can also watch this 3-step strategy. Oh, looks like someone made a video on it too. Nice. Well job. Good job. So why is it that I'm confident in this? Is it just because of the 3-box? No. It's because I'm aware of where I am in a story and a narrative. I know that my weekly time frame, right? So we can do it like this. I know that my weekly time frame is currently liquidating 5.5-year long highs. Very bullish, right? So I'm aware of already what's happening there. And we are above the weekly range. However, we are just pumping bullish, right? I'm also aware on the daily that we've created multiple bullish structural ranges, and we are currently, right, remember where we are. Remember the high I drew out here, right here? That's that daily high. So we are currently working on potentially running the next daily high as part of the continuation bullish liquidity, right? So again, you could do this over and over again every day and get used to it, but I'm already aware of what's happening, right? This is taken within the context of multiple time frames. Weekly, very bullish. Daily, delivering bullish, has been delivering bullish, is within the Wyckoff markup phase, has been undergoing accumulation, reaccumulation, and giving those 3-box entries and continuing to break long. Therefore, we expect it to continue breaking long, just like in the video that I made for you guys. If it's if you force longs, it's going short mentfx, right? In this video right here. Again, words to live by. Live by that rule, understand it. And this actually applies to almost anything in life. So again, if it's long, we want to be long. We don't want to force shorts like other smart money might be doing. The 4-hour is, I think it's still bearish, but again, we're under the supposition that we should be bullish. The 1-hour has just shifted bullish, and not only has the 1-hour just shifted bullish, but it also has double shifted bullish, which means under Dow Theory, we have now created a continuation in that price, which means we now want to really hold above and continue pushing. So the 1-hour is still pushing long, therefore it should continue pushing long. The 1 minute just made an impulsive 3-box break to the top side that we can now use to get involved. And the 15-second is showing us that exact same 3-box setup break with a refined S&D zone that makes sense using the principle of volume within the S&D candles. It is beauty. It is so beautiful. So that's where I set my alert, and I wait, and I go make my coffee to get more cracked out on caffeine before I come back to start clapping as price does what I need it to do. I get my alert. It goes off as price hits the area, okay? Price hits the area, and already, so I'm not going to break down my exact entry criteria for you guys here because it's a private concept that I only teach in the private mentorship. For those of you that are in the private mentorship, the entry here is a fractalized double MB, and you can figure out where it comes from, but it's off of this buy stop right here to continue going long. Okay, guys? So you guys know where that comes from. I believe that was my entry. Let me double check again to make sure it was for you guys. Yep. So double MB break or fractalized double MB off there. However, for those of you that have been learning on my channel and you want to know what's up, you can jump down to that lower time frame using something like the rule of 30, which I also have a video on, right? And again, even though it may look ugly, you can still follow this through, right? You have weak to strong hands, the break of structure, the retest of the prior accumulation, and the continuation onwards. So instead of showing you my exact fractalized double MB entry, because again, that is reserved for the private content, because there's a progression of knowledge that occurs there too. Just like a lot of you that have been following me for a while on YouTube publicly know that, you will get really confused if you haven't seen my other videos. Similarly, in the mentorship, I have a different way of teaching some of these concepts and the way that I bring them forward, which means there is a progression there that then takes you into this idea of the fractalized double MB. However, nonetheless, you can still apply exactly what I teach under the 3-box setup, because remember, if we have the 3-box on the 15, we can confirm this using a lower time frame, aka a Wyckoff on a lower time frame. Now again, you could do this on a 15-minute and a 1-minute. I'm showing you this across multiple time frames. In my last few videos, I used the weekly and daily to show you examples, and the 4-hour, here I'll be showing you 15-second and 1-second, all right? Because all of it's the same. So once again, where is that weak to strong hand transfer? You have the selling climax, right? The AR, the ST within it, right? So this is the AR, the ST. So you can see how very, very algorithmic price is. Then price creates within it more STs, and then another ST. This could be considered an STB or an ST. Both are valid. However, we're going to call it an STB. And again, there are certain rules for STBs. They do not have to be below a selling climax. And I go over these on mentorship. However, you can read some stuff on Wyckoff to understand this. Okay? But again, a lot of people would come to me here and say, Anton, this is too low of a time frame. No retail or no trader is looking at this time frame here, trying to buy this double bottom. No, they're not. However, for any of you that have been in the retail space, right? I'm sure you've been here because I've been here. Some of you use a confirmation, or some of you are psychologically wired to get involved on a buy if you see little jumps in price. And what I mean by that is, let's say you're watching a 1-minute candle, right? So here's a candle, a 1-minute candle. But let's say that 1-minute candle, let's draw it like this, right? Here's a 1-minute candle, boom. Right? But that here, let's make it actually easy. Here's a 1-minute candle, but that 1-minute candle continues to make, a move up, right? And then disappear. A move up, disappear. A move up, disappear, right? Like creating that wick, right? So you guys know what I'm talking about. You guys have probably been there, right? There's a wick. And then, it makes, sorry. Here we go. Right? So let's say this is a bullish candle. So it makes that move up, disappears. Makes a move up, disappears. On a 1 minute, right? Up, disappear, up, disappear. That's what these little fractal things are right here. It's a move up, disappear. Move up, disappear. But what's happening is, as that's occurring, and as people are psychologically wired to do the dumb thing, and as retail is wired to get involved on a emotional impulse, right? Especially if you're new and haven't tested a system. When you see that move up, come down, move up, come down, that's your confirmation sometimes that, oh my God, this market's about to break long. It's going to break long. So you get involved at that moment on that potential break, right? Maybe your stop loss is even lower, like that, below the low that's being made. And you want to take that long, and then, it comes down. And again, long comes down, long comes down, long comes down, long, and you want to get in there, and then it liquidates you. That's where those second time frames still are useful, even when it comes to using fractalized, very fractal Wyckoff, right? So remember, it's not that retail is just sitting here on a 1 second looking for a double bottom. It's the fact that retail has ways of confirming that still will psychologically get them involved, which allows this algorithmic thing to continue playing out. And this algorithmic thing is also creating the perfect structural impulses for that smart money, or smaller smart money, to get involved with positions. Then you have the SOS in phase B. The move down that liquidates all the lows created here, because remember, this for other retail is the buildup on a higher time frame of lows, right? On a higher time frame for retail, this is a buildup of those lows, like starting to hold, right? So for some it's a form of support, and they're going to be stopped on that. That's how you have to think about it. No matter what time frame you look at, it's all the same thing. Then you have the spring down that takes out the lows, and now all you're waiting for is a break of structure to the top side, which does what? Shows you on one hand that Dow is switching bullish, on another hand that weak to strong hand transfer is occurring, right? And on the third hand, happening within a long-term bias of a very bullish market. And as you get that break right there, you can enter already with a buy stop So this is actually something that is kind of mentorship related, but I'll share it with you guys here. You can buy stop and again, this is not financial advice. You can buy stop the actual accumulation as your entry criteria, because sometimes price will break and run, because Wyckoff has occurred, weak to strong hand has occurred as well, and price now needs to just run. And this will happen on all time frames as well. So that could be one of your confirms. However, another one is to trade the retest of the SOSB or the AR, right? So in this case, it didn't come to the AR, but the SOSB is a fine retest you can trade. This is the only time, for instance, a break and retest of a zone actually works, right? So it's not like break and retest is a bad formula for trading. However, break and retest used with the wrong lines and with the wrong support resistance areas doesn't do anything for you. You're going to be stuck on both sides nonstop, right? That's why there's so much hate behind smart money concepts, because a lot of retail sees smart money like Wyckoff and goes, oh, it's a head and shoulders, right? Without understanding there's a lot more to it than just that. And there's a lot more bias building and story building that goes into it. And there's a big reason as to why, there's a big reason as to why retail is 80% short on UJ when it's moving like this, right? And there's a reason that we are long on it during the same time. Okay, so again, you're getting that confirm there, and that can be your entry as a buy stop to the long side, and you're looking to take that maybe, protect below the spring or just below the last mitigation, because theoretically, again, if you follow and think about the volume of price comes down impulsively, comes up, tests the last down move here before breaking up, so price should never come back below this low, even though this is the real protected low, right? So there's ways to play with RR there if you want to move that SL up a little bit. However, it does mean that sometimes price will come here, tap it, and then go. However, with that understanding, maybe it's worthwhile for you to build that RR system, because even though it might hinder your win rate a little bit, your RR is higher. But that could be your entry, right? Now, my entry specifically was off the 15-second, off of the inside buy stops here, off fractalized double MBs with the protection under that low. So again, I'm not going to break down this right now, but that is a fractalized double MB. And for anyone that, has been in the mentorship, check out what that means. You guys, there's tons of videos on it in the live trading section, as well as in the webinars, as well as in the process section. Otherwise, if you want to learn about it, feel free to join up and check it out, right? It's beautiful. And my first partial is always at 1 to 10 usually. Okay. So what I'm looking for is my 1 to 10 to be met. So price comes in, plays around here, all good, that's normal. And then price hits my 1 to 10 right here. So I took off +5 at this point right here. So I took off 5 RR, right? And again, it's not just 5 RR straight, right? Remember, it's not 5%. I risk 0.2%, so I only took off 1% on my overall account gain that during this trade, right? And again, before that, there were break-evens, which factor into those losses. So again, when you hear me say +10, +15, +20, I'm not just saying I'm making like 15%, 20%. That's absurd. You got to be fucking crazy to think I'm doing that every single day. Like, it doesn't occur that way. I have a very lower risk for my higher R gains. And once again, because I'm on such low time frames, commissions do affect that bottom line as well. However, I'm up a lot more RR than I'm down. So I'm okay with this. And again, I'm not going to prove myself or anything. Again, all of this is for educational purposes only. You can take it or leave it, right? At the end of the day, all you need to do is test it, and you'll be surprised how far you can get. But now what's interesting, okay, so I think this market then just continued to really mark up. Not 100% sure. I did not catch it all the way up. We had members that did. So let me actually see if it did. No, so actually you can see it came back down to take it out, right? However, I got out somewhere here. I'll show you guys how in a second. However, we had other members in the mentorship positioned in here on the Wyckoff, positioned in here on the Wyckoff, and here on the Wyckoff, and in here on the Wyckoff, right? We have ways of positioning ourselves everywhere, because we understand that what we do consistently reoccurs fractally across every time frame in the market, which is why I'm able to do what I do even on a very low time frame. So after getting involved, right, what did I tell you guys is really important? In the case that you are involved, and again, if you've made it this far in this video, here's another little gem for you, right? In the last 3 videos, we've had some immense gems dropped at the very end. So if you've been making it, oh baby, you're gonna love it, right? Just like I spoke about the fact that in Dow Theory, when you have a structural continuation, the way we can tell a real reversal in price, or at least a good telltale sign that price is probably going to continue in an opposite direction, is when we get a break and then a double break and the confirmation of that break. So this is Dow's continuity theory, right? And the idea now is that it's either going to just continue slithering down, or maybe it drizzles down a little bit. Sometimes it'll still just break upwards. That's fine, it happens. because it might have been part of a different impulse, but it's a very good way to tell when a trend might be ending on a given time frame. So that means even on a 15 second. So because I'm in on a 15 second, and here's something you can use again, whatever time frame you use to enter your trade, you could begin to follow, especially in the very early stages of the trade, to potentially exit in the case that you haven't caught the quote-unquote low of a given session or of a given market before, maybe it wants to come back and then go actually long, which it actually did, if you guys remember, right? So what you can do is, just like we can use that continuity theory to get involved and start getting in short, we can also use that continuity theory to get out of the market, right? So what I mean by that is, if we now follow this, right? I was still running on this all the way, by the way, right? And I had my partial here, but, let's follow it. Bullish, 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 bullish. So we're still in a bullish market. Then price finally, did it break here? Yep. So price finally broke, right, and became bearish. Now again, because we're somewhat close to the entry, I'm not going to step up a time frame and apply this rule on a higher time frame. Instead, what I'm going to say is, either A, this is part of a bigger time frame degree to keep going long, which means we're good to hold it, or B, the continuity theory, right? Here's break 1, might be in motion, which means if we get another break now, a break 2, there's a good chance that that's going to result in price either, again, coming to hit the inside zones here for smart money to continue getting in, or just continue drizzling down, right? Even if it drizzles down to here, I don't care. I want to get out. So what I did is I waited to see if that would break. I waited, came close. I was still in it. Right there is where I exited. So the other 50% of my position, I exited right there at about 1 to 15. So on that position, I secured about, here we go. 1 to 15 is a plus 7.5, right? So overall, it was about, so I lied. It wasn't actually plus 10. It was actually a little bit more. Oh my God, sue me. So that makes it what, 10, 11, so about 12.5 overall secured on just this trade, right? So we secured about 12.5 RR on this trade, just using that continuity theory, right? Using that as a trailing method, and then it broke down. So that's your mini psychological nugget of the day. It's a good way to ascertain if a trend might be over and if there could be a potential better exit for you, right? Instead of letting it just come back to break even. And then you can see it does actually take out my entry. So I'll go to a higher time frame here and just show you this. Right? Boom. And it's come to take out my entry right there, I believe. And then I think it even comes lower, right? But the idea is using that double break of the Dow Theory continuity, right? Of getting involved and understanding what actually might act as a protected high rather than just a quick little liquidation that wants to continue, right? In the state of Elliot. So again, if you don't know what I'm talking about right now, make sure you've checked out my last few videos where I broke down this understanding, this mentfx philosophy that now follows under the umbrella of Dow Theory, Elliott Wave Theory, Wyckoff Theory, muddled with smart money, put together, jam-packed into the most beautiful system and philosophy you can have, the mentfx theory. So once again, guys, thank you so much for watching this video. I hope you enjoyed it. There's Mr. Krabs holding up his money. I hope you guys are all having a good weekend. Actually, I might not release on the weekend, so I don't know why I said that, but I hope you're all having a great week. I hope you're all going to have a good week going forward. If you're ready and you're killing it on the markets, consider the link above. That is the funding. Otherwise, if you want to take your own learning to the next level, take videos like this or concepts like these and take them to their own next level with extra depth and actual private exclusive things that are taught from a step-by-step basis and tailored towards you, especially with webinars every single week, and markups and answers and a community that is actually willing to help you, support you, and is probably one of the non-toxic communities you're ever going to meet because everyone there is after the same goal. Consider that link below and consider the one you see on the bottom of my screen. So that's all for the advertisements. I hope you guys enjoyed it. I hope this video spoke to you. I hope it changed a certain way of how you analyze, how you think, and thank you all for participating. See you guys.